the lesson today is going to be balance sheet with adjustments. So remember, we had done the income statement with the 3 adjustments. So we had to calculate whether there was an increase or whether there was a decrease in the provision for doubtful debts. We had to deal with accruals and prepayments, and we also had to calculate depreciation expense. We still also now, when we go into the balance sheet, we also have to deal with the same 3 adjustments. So it will just be the top part of your balance sheet. So the bottom part in terms of your capital, no adjustments. Yay. But the top part, you will have to start with your non-current assets, which deals with your accumulated depreciation or your provision for depreciation. And then you will go to your current assets, where you will deal with both the provision for doubtful debts and 2 of your accruals and prepayments. And then lastly, it would be your current liabilities that only deals with the accruals and prepayments. 2 of them, accrued expense and prepaid revenue. So once you have done all of that, the top part of it, you dealt with all of your adjustments, and you will just do the capital section. But for now, we are starting the balance sheet, of course, with your non-current, which, as we said just now, deals with your provision for depreciation. So the depreciation expense, or the annual depreciation, would have already been calculated and entered in your income statement based on the method, whether it was straight line or reducing balance method. Please review that video in terms of the calculations, and also look back in your notes and your books to see that if you need to. But it is basically, once it is stated how it is depreciated in the notes, you calculate your depreciation expense and it goes into your income statement. So when you come now to do your balance sheet, you are dealing with it in your non-current assets, which is the first category that we start with. And it will be the non-current asset at cost less your new accumulated depreciation. So let's go into the balance sheet to see how that is done. So once again, you're preparing your balance sheet. You start with the name of the business, your balance sheet as at, and your ending date. And you have your dollar signs. And as we said, the first category, non-current assets. And because we have to account for the accumulated depreciation or the provision for depreciation, we use these 3 columns. We name one cost, we name one accumulated depreciation, and the last one, NBV, which represents net book value. So you will identify in your question, these are examples, but you will identify in your question what are the non-current assets for that particular question. You list it in the order of permanence. So land on buildings, land and buildings always first, or land first, then buildings, and then you come down the list in the order as normal. That has not changed. And then in your trial balance, you will find the cost of each of the non-current assets. Remember, account for all of your non-current assets, whether it has been depreciated or not. So this is why you go and you check for that first, and you can list it. You get the cost for each from your trial balance. Accumulated depreciation will depend firstly on whether it is depreciated. What you can do is you're looking for provision for depreciation in your trial balance for each of the non-current assets. And to get your new accumulated depreciation, which is the amount that goes here under the accumulated depreciation middle column, it will have to be your provision for depreciation from your trial balance, add the depreciation expense that you calculated and entered in your income statement. So remember that your new accumulated depreciation would be your provision for depreciation in your trial balance, which was the one from before. Add the calculated depreciation expense from your income statement, and that will give you your new or your current accumulated depreciation, which goes into your balance sheet under this column. Okay, and you will just do this for each one. Look at the previous accumulated in the trial balance, add the amount that you calculated for that non-current asset. You can just look in your income statement and take that figure, and when you add it up, it goes there. Remember, we did a video on that. Balance sheet, non-current assets, you're using your 3 columns: cost, accumulated depreciation, and your net book value. Make sure and check your questions. So this is very, very important. So we have land and buildings, 230,000. So that is what we are going to have to do for the balance sheet. You're going to put your land and buildings, 230,000. Accumulated depreciation, it was not depreciated. So you can either put 0, you put a dash, whichever one, and therefore your net book value, 230,000 minus 0 is 230,000. So fixtures and fittings, the cost was, you would check the cost in terms of your question. So the cost was 45,000. So 45,000, and your accumulated depreciation for fixtures and fittings, your accumulated depreciation before is the same as your provision for depreciation. So that means your accumulated depreciation prior to your annual depreciation being calculated was 16,200. 16,200, and then you just add your annual depreciation to it. So this is what your steps will be. You work out your annual depreciation, and then to find your accumulated depreciation, it will be the one in the trial balance, provision for depreciation, fixtures and fittings, the 16,200, so the previous one, and then you add the annual one that you just calculated. And then you will get your accumulated or your new accumulated as 21,960. And then of course your net book value is simply 45,000 minus 21,960, which will give you 23,040. So same thing for motor vehicles. What was the previous accumulated depreciation? Motor vehicles, you look for provision for depreciation. So you're looking for the provision for depreciation for the accumulated motor vehicle. It was 14,000. So 14,000, and you calculated your annual as 11,250. So you add that to your previous, and you will get a new total of 25,250. And that will mean 24,750. And then finally, you do the same thing for your office furniture. Office furniture provision for depreciation, 4,500. Add your newly calculated annual depreciation of 15,000, and that total will give you $6,000. Office equipment, your total was 10,000. You see it in your balance. Accumulated depreciation, 6,000, and your net book value, 4,000. Okay, good. So for those of you that went back to review, you're now back with us. We have calculated, we have accounted for that part. So the next stage, of course, will be to go to the next section. We've dealt with your non-current. We are now going to deal with your current assets. Okay, so your current assets, the next one, you start with your closing inventory. Closing inventory is the one that you get in your additional information or your notes to the accounts. And then you have to account, you would usually go with accounts receivables. You now have to account for your second adjusting entry, which would be your provision for doubtful debts. So your provision for doubtful debts, which was calculated as your percentage of receivables after any bad debts in the notes. Remember, we did that as well. You can go back and review that one as well. But just remember that if bad debts are in the notes to the accounts or the additional information, to find your total provision for doubtful debts, you will have to subtract those bad debts in the notes from your receivables and then find the percentage of it to get your total. That total that you calculate is the total that goes into your balance sheet. So what we have after we have done and we have accounted for the provision for doubtful debts, where you see you have your receivables, your less your total, and that gives you a net receivables that goes into this column here. Then you have the next section, which would be your prepaid expense and accrued revenue. So in other words, we are now going to account for two of the accruals and prepayments as they stand under current assets. After we have done that section with your current assets, after you have accounted for your accruals and prepayments, you go back to doing the rest of it, which if there's any bank figure, if there's any cash figure, and then you add up all of your current assets. The next section will be your current liabilities, and there you will account for any of the accruals and prepayments, the other two, which will be accrued expenses and prepaid revenue. See, I almost made a mistake. Accrued expenses and prepaid or unearned revenue. So it's to just follow the format. Always remember, just take one step at a time, and then you will have it. Okay, so what we had, remember we were talking about the current assets. So after we did the non-current assets, we had the current assets. You start with your inventory, then you go with your accounts receivable. You have it here in the first column because we have to adjust it. Less provision for doubtful debts, which you would have calculated percentage by receivables after bad debts in the notes. Remember that if there were bad debts in the notes, you have to minus it or subtract it from your receivables figure in your trial balance and put the answer here. Okay, review that for me, please. So then you will have your net receivables that goes in the middle column, back to the middle column underneath your closing inventory. And then we're going to account for your prepaid expenses. Remember, it has to be separately, and you have to give the specific name like prepaid rent, prepaid insurance, prepaid electricity. And then your accrued revenue, like accrued commissions received, or accrued interest received, or accrued rent revenue, however it is, the specific name that is given. And then when you have accounted for all of your accruals and prepayments, or at least the two, accrued revenue and prepaid expenses, then you go back, you check for any bank figure, any cash figure. All of these are going in the middle column. And when you have accounted for all, draw your line, add up, and get your total current assets. You have now completed that section. You're now going to deal with your current liabilities. You start with your accounts payable. or your creditors, depending on the date of the question. The old time one call it creditors. So your accounts payable, any short-term bank loans, and then you're going to deal with your other two, accruals and prepayments. So current liabilities only deals with accruals and prepayments. You check to make sure, once again, it's accrued rent, accrued insurance, whatever the specific expense is. Same thing for the prepaid revenue, whatever the specific name of the revenue is. Once you have accounted for all, you have it in all in the first column, you will just add it up, and your total current assets less your total current liabilities will give you your working capital, which as usual goes in the last column. That has not changed, to be added to your non-current assets, okay, which would have been on top. And that will give you your first total. And after you get your first total, then you will go to the last section, which is the capital section, which is the same thing that you have always been doing, because there are no adjustments down here. The only thing is that you now have to add your net profit or less your net loss, but we have always been doing that after we did the income statement and we knew how to calculate profit. This has always been the format. So you will just continue like that. Opening capital, add net profit or less net loss, less drawings. That gives you your closing capital figure. Then you check for your last section, which is your non-current liabilities. Mortgage bank loan. If there is mortgage bank loan, you can put it here and you add your two totals, which is your closing capital to your non-current liabilities to get your second total. And your second total should be the same as your first total. And that means when it is, it has balanced. Remember though, that even if you don't get it to balance, do a quick check, but do not spend too much time on it. You could go on to another question, please. And only if you have time, come back and see if you can find the error, because it could just be one error. I am just going to emphasize again, do not ever just go helter-skelter, changing up all kind of figures. Everything must be a certain method, process, procedure. Follow that and have confidence in it, that what you did before would, most of it would be correct, because you have practiced and you've put stuff into it, okay? So don't go looking for that one error and go changing up all over the place, right? Hope you understand that one, because I've seen it happen and then you end up losing marks. So that is basically it for the balance sheet and the income statement, which we did before. Review some of the videos individually, just focus on one thing at a time so that you don't get overwhelmed. Practice, practice, practice a lot, and by the end of it, you will be getting it like that. Okay?